Hey there, welcome back. It's Ben. In our last conversation, we sat down and got to know my rather unpredictable business partner, Mr. Market. We learned how to see through his emotional outbursts, the manic highs and the depressive lows, without letting his chaos become our own. That was the first and perhaps most important step, building the psychological fortitude to stand apart from the crowd's emotions. But once you've built that foundation of inner discipline, a new, equally critical question naturally arises. It's the question that every serious investor eventually confronts in the quiet of their own thoughts. All right, Ben, I'm calm, I'm patient. I can watch Mr. Market's daily drama without feeling the urge to react. But when I finally decide to make my move, when I commit my hard-earned capital, how can I be sure I'm not making a catastrophic mistake? What if my careful analysis of a company's intrinsic value is fundamentally flawed? What if I overlooked a critical liability buried deep in the footnotes of an annual report? What if an unforeseen technological disruption or a new aggressive competitor emerges just months after I buy? This, my friend, is the nagging fear of being wrong. It's the vulnerability that comes with action. And today, I'm going to give you the ultimate answer to that fear. It's the single most important concept I ever developed in my entire career. It's the cornerstone upon which all intelligent investing is built. I call it the margin of safety. I want you to think of it not merely as an investment strategy, but as a profound philosophy of humility and prudent action. It is the conscious admission that the future is inherently unpredictable, that you are not omniscient, and that you can and will be wrong some of the time. More importantly, it is the built-in financial shock absorber for your portfolio that ensures when you are wrong, you don't suffer permanent loss of capital. Let me illustrate this, not with a complex financial formula, but with a simple story from the world of engineering. Imagine you are the chief engineer tasked with building a vital bridge across a major river. Your calculations, based on the best available data, show that this bridge needs to reliably support 10,000 pounds of traffic each day. Now, a reckless or overconfident engineer might design the bridge to hold exactly 10,000 pounds, but a wise, prudent, and experienced engineer, he would never take such a gamble. He understands the variables he cannot fully control. He knows that a sudden storm could create unprecedented stress, that a convoy of trucks might exceed the weight limit, or that there could be an undetected flaw in the steel. So he builds the bridge to hold 15,000, maybe even 20,000 pounds. That extra 5,000 to 10,000 pounds of capacity is his margin of safety. It is not wasteful, it is wise. It accounts for the unknown, the unpredictable, and the fallibility of his own calculations. In the world of investing, you are that engineer. The company's carefully calculated intrinsic value is your 10,000-pound estimate, your best guess at what the business is truly worth. The margin of safety is the significant discount, the extra capacity you deliberately demand before you even think about building that investment into your portfolio. It is the crucial difference between the price you pay at the moment of purchase and the underlying value you believe you are receiving. This gap, this buffer, is what transforms a speculative gamble into an intelligent investment. So we've established the why. It's a philosophy of humility, an admission that we are not fortune tellers. Now let's get our hands dirty and talk about the how. How do you actually calculate and apply this margin of safety in the real world? It's a concept that is simpler than you might think, but it requires a fundamental shift from a speculator's mindset to that of a cautious business owner. Let's make it painfully practical. Imagine you've spent weeks doing your homework on a solid company. You've diligently read the annual reports from cover to cover. You've analyzed the cash flow statements to ensure the business is generating real wealth. You've assessed the management team's track record for integrity and capital allocation, and you've thoroughly studied the competitive landscape to understand the company's moat. After all this rigorous work, you confidently conclude that the company's intrinsic value, what you believe the entire business is truly worth on a discounted cash flow basis, is $100 per share. Now here is the critical fork in the road where the amateur and the professional diverge dramatically. The amateur, brimming with excitement from his analysis and gripped by the fear of missing out, FOMO, sees the stock trading at $95 and thinks, it's a bargain, I'm buying, I'm getting a $5 discount. He has a mere 5% margin. This is not a margin of safety, it is an illusion of one. It's a razor-thin edge that offers no protection against any error in his calculations or any minor bad news. The intelligent investor, however, does something that seems counterintuitive, even difficult to most. He takes out his calculator and he deliberately demands a much larger, more robust buffer. He says to himself, my $100 estimate is my best, most educated guess. But it is still a guess. I am not infallible. To protect myself from my own potential errors, from unforeseen industry disruptions, or from a temporary economic downturn, I will only buy this stock if Mr. Market is in such a state of despair that he is willing to sell it to me for a steep, undeniable discount. Let's say $70 per share or even $65. That $30 to $35 difference between the price he pays and the value he perceives is his genuine margin of safety. That's a 30 to 35% buffer. This is not being greedy. This is being profoundly smart and self-aware. This discount is your financial reward for admitting that you don't know everything. It's your compensation for your patience and discipline. Now, I can already hear the objection forming in your mind. Ben, that's completely unrealistic. A wonderful, high-quality company would never fall that far below its intrinsic value. I'd be waiting forever. And I would give you a two-part answer. First, you would be genuinely surprised how often Mr. Market, in his deep fits of pessimism and panic, offers wonderful, well-run businesses at fire sale prices. It happens more frequently than financial media would have you believe, especially during times of general economic fear or sector-wide sell-offs. These are the moments when true fortunes are built by those who have the cash and the courage to act. And second, if the stock never gets that cheap, then you simply do not buy. This is a crucial point. Remember, your most powerful asset as an investor is not your ability to analyze a balance sheet. It's your ability to say no, to walk away from a mediocre opportunity, and to wait patiently with cash in hand for the right pitch. The stock market is not a place where you get rewarded for constant activity. You get rewarded for being right and for having the immense discipline to act decisively only when the odds are overwhelming. overwhelmingly, undeniably in your favor. The margin of safety is the practical tool that tilts those odds dramatically in your favor. It systematically transforms the art of investing from a stressful game of precise prediction into a methodical game of favorable probabilities. You're not trying to hit a bullseye every single time. You're ensuring that even if you hit the outer rings of the dartboard, you still walk away from the game a winner with your capital intact and ready for the next opportunity. Now, I know what some of you are thinking. Ben, this all sounds great for your time, but the market today is different. It's faster, it's more efficient. Information travels at the speed of light. Don't algorithms and hedge funds snap up these bargains instantly? It's a fair concern, but it's based on a misunderstanding of where these opportunities truly come from. Let me be very clear. The greatest bargains do not appear because of a lack of information. They appear because of an excess of emotion. In 2025, Mr. Market is not slower or less informed. He is, in fact, more hysterical than ever. And this is your greatest advantage. The modern financial landscape, with its high-frequency trading and 24/7 news cycle, does not eliminate the margin of safety. It amplifies its power. Why? Because it creates volatility. It causes prices to swing far beyond any rational fundamental value based on the fleeting sentiment of the crowd. A company can be crushed 40% in a single day because of a missed earnings estimate by a few cents or a negative tweet from an influential figure. For the speculator, this is chaos. For the intelligent investor, with a margin of safety framework, this is the hunting ground. Let's take a real-world example. Imagine a strong, profitable technology company that normally trades around $100 per share. A quarterly earnings report comes out. The company is still growing, still profitable, but its growth slowed slightly compared to unrealistic analyst expectations. The headline on financial news screams, "Tech giant misses target," and the algorithmic trading machines instantly start selling. Panic spreads. Herd mentality takes over. Within hours, the stock is down to $70. The speculator sees this and panics, selling his shares to avoid further losses. The financial media fuels the fear. But you, the intelligent investor, what do? You don't see a falling knife. You see a potential opportunity. You calmly pull out your previous analysis. You determined this company's intrinsic value was $100. You demanded a 30% margin of safety, meaning your buy price was $70. And now Mr. Market, in his hysterical state, is offering it to you at exactly your price. This is not luck. This is the system working as designed. The volatility caused by modern markets is the very mechanism that periodically delivers these wonderful businesses to your doorstep at a discount. Your job is not to predict these swings. Your job is to be prepared for them, emotionally and financially. Have your watch list of quality companies ready. Know your intrinsic value estimates. Know your required margin of safety. And when the inevitable panic hits, you do not join the herd running for the exits. You calmly walk in the opposite direction and do your shopping. This is how you turn the market's greatest weakness, its emotional volatility, into your single greatest strategic advantage. The margin of safety is your ticket to doing business with a desperate emotional seller who is willing to part with a valuable asset for far less than it's worth. That is a game you can win again and again. So we've covered the mechanics, the math, and the modern application. But I want to finish our discussion today by talking about the most valuable benefit of the margin of safety, one that goes far beyond the balance sheet. I'm talking about psychological freedom. You see, most investors are trapped in a prison of their own making. It's a prison of anxiety, of second guessing, of watching stock tickers compulsively, of lying awake at night worrying about their portfolio. Every piece of news, every market swing feels like a personal threat. Why? Because they have no buffer. They are operating with no room for error, walking a financial tightrope without a safety net. The slightest mistake, the smallest unforeseen event could lead to a devastating fall. The margin of safety is what cuts the rope and sets you free from that prison. When you have built a significant buffer into every investment you make, your entire psychology changes. You stop being a predictor and you become a prepared opportunist. You no longer need to be right 100% of the time. You can be wrong on your valuation. You can be early in your purchase, and the market can take longer than you expected to recognize the value, and you will still be financially just fine. That 30% discount you demanded is what absorbs the shock of your own fallibility. This creates a profound sense of calm and confidence that is utterly foreign to the average market participant. When bad news hits and the market is panicking, your first thought isn't, oh no, I'm losing money. It's, is this panic creating an opportunity for me to buy more of a wonderful business at an even better price? This is a complete inversion of the typical investor mindset. It transforms market downturns from sources of fear into sources of potential opportunity. This psychological shift is not a small side effect, it is the entire goal. The ultimate purpose of intelligent investing is not just to accumulate wealth, but to do so in a way that allows you to live a peaceful, rational, and happy life, unshackled from the daily drama of Mr. Market. The margin of safety is the key to that shackle. It is the tool that allows you to make investment decisions from a place of logic and patience rather than a place of fear and greed. So as we wrap up, remember this: Mr. Market teaches us how to think. The margin of safety gives us the courage to act. It is the practical application of the wisdom we gained from understanding our emotional business partner. Combine these two ideas, the psychological discipline to ignore his moods and the financial discipline to only transact at a deep discount, and you have a recipe for not just investment success, but for investment serenity. In our next conversation, we'll delve into how to actually identify those wonderful businesses in the first place, how to find the companies worthy of your careful analysis and your patient capital. But until then, practice this discipline. Build your watch list. Calculate your margins and wait for the pitch that you cannot miss. Thank you for your time, and remember to always invest with a margin of safety.